Welcome to another episode of Your Money, Your Mission, the podcast designed to turn complex financial situations into actionable advice, powered by Johnson Financial Group. I'm your host, Kelly Mould, and today we're going to have a real conversation about what's happening in the markets when it comes to home buying, both for first-time homeowners and for those that are seeking their forever home. Joining me today, I have two incredible guests, Sara Whitley, AVP Senior Community Mortgage Loan Officer, and Tony Petrie, VP Mortgage Field Manager. Great to have you both.
Yeah, thanks for having us.
Great to be here.
Wonderful. So before we dive in, make sure you subscribe to Your Money, Your Mission wherever you listen to podcasts for consistent financial guidance every other week. All right. So let's start talking about what happens or what is happening right now in the market. It's been a little bit different for folks. So share with me what someone in Wisconsin looking for a home is faced with today.
Sure. Well, I work primarily with a lot of first-time home buyers, and it has become a more difficult market because housing prices keep going up. But currently in the market, interest rates are normal. We got used to rates being 4% during 2020, 2021, but interest rates are at a normal rate, what they were before. It's just getting out there and getting pre-approved and talking to your lender right away.
Are you still seeing a lot of buyers waiting for those interest rate to drop with this expectation we'll get back there?
Yeah, I feel like we waited, I think there was like 2 years. People were like, we're going to wait. But I think those that are saying that they're going to wait, they're not waiting anymore.
Right.
Because I think they're finally realizing that rates are now, we're around the 6% rate. Like, why not go now?
Right.
Yeah.
So, Tony, are you seeing the same trends in those that are seeking a forever or a second home?
We are. We're really working on, getting over that lock-in effect of people that are locked in at the 3% rates, to where the more realistic rates are now. But they're still doing it, because of lifestyle changes or, growing families, job changes. So it is happening, but it really is, getting over that mental block of going from a 3% to where rates are now.
Right.
But a lot of people are jumping on that because the longer they wait, they're also losing out on building that equity that they could have been doing by getting the home they wanted with where, the current rates are.
Right. And I hear a lot of conversation about inventory. For a while, there was no inventory. You had to offer so much more than the asking price. It was becoming, I think, a little bit challenging for buyers. What is it like out there in terms of inventory today?
Inventory has gotten better because those secondary buyers are now listing their homes. It's still a challenge. The housing prices, I think, is more of a challenge, but the inventory I have seen increase. And when I look at the stats from Wisconsin Realtors Association, they do say inventory is higher than it was a year ago as well.
Yeah, and the other thing too, we're seeing is, we went from a seller-driven pandemic era, right, where people were waiving contingencies and waiving inspections and things like that, and we've definitely seen it stabilize a little bit back to normal.
And that's good news then, I would think, for folks. And then, Tony, in terms of buyers that are moving up and navigating the market, what is the role of equity? Because they are in a little different position than a new first-time buyer, correct?
Equity is huge. It really gives you that flexibility with your down payment, among other things. So, when you build the equity, which is essentially, what you're going to be able to sell your home for versus what you owe on it, what it does is it gives you the ability to put more down payment down to make, maybe a more attractive offer. The other things you can do, some people are putting less down payment down and holding some of that equity back to when they sell to do home improvements on the new home if they'd like.
Okay.
A third option is some people will put part of the equity as down payment and then maybe pay off some high interest debt like credit cards or auto loans or things like that to help free up the payment for this new housing payment. But what it does is gives them a lot of different options.
Right. And Sara, you were mentioning before the people that were waiting, they were losing out on that opportunity to build that equity over the last few years by holding off. And that's such a powerful tool.
Absolutely.
So, it's funny. I just had Sunday dinner with my family, and my son and daughter-in-law are thinking about buying a new home. And the interesting thing is we started to have this conversation. Oftentimes people don't know exactly where to start. So Sara, let's say we have that situation. What advice do you have for people going, I want to do this? Where do I start?
Call me.
Very good.
Well, the first thing is, yes, call your lender if you're even thinking about it, having that conversation, but then also like getting educated. There's so many resources out there to do homebuyer education because there's a lot of myths out there saying you need 20% down. Just get educated, knowing what you need to know, because you don't know what you don't know. But I sometimes talk to people a year in advance, 6 months in advance. Don't wait until you're 2 months out from your lease expiring, but just sit down and have a conversation and just run basic numbers with,
know where
with
you're,
the lender.
you're at and what the market's like.
Yeah.
So people get confused a little bit about pre-approval and pre-authorization or pre-qualification. What should we really be focusing on?
Getting a pre-approval. The difference is a pre-qualification. You've heard of like those online lenders. You fill out the application saying, hey, you're pre-approved, but that's really a pre-qualification. You're entering your information into the system and saying, yeah, we can give you this money, but they're not actually verifying. They're not verifying your income. They're not verifying your assets. They're not doing a deep dive on your credit.
Pre-qualification is really nothing.
It's really nothing.
Okay.
So doing a pre-approval, it really doesn't take that much time. We can do them within a day or two here. Just getting pay stubs, W-2s, bank statements, and we can do them really quick. So, and it gives you a more stronger representation to the seller saying, my bank has already reviewed everything, so now we just have to approve the property. So we've checked the boxes, so there is less risk when you're writing the offer. And I think our reputation at JFG is we do fully underwritten pre-approvals. So
buyers and sellers can be very comfortable that
Absolutely.
when we come in with a pre-approval, it's good to go.
Absolutely. Yeah.
So there's still first-time buyer programs out there,
Oh,
right?
so
There's still
many.
people shouldn't just automatically go, it's an impossible dream. There's still options, right?
Yes, absolutely. So as first-time home buyers, there's so many options. There are down payment assistance options depending on your income level throughout the state of Wisconsin. There's options where allow you to do 100% financing by financing your down payment and closing costs with that assistance programs. But there's options for all income levels. But I work mainly out of Madison, and our rent prices are out of the world. And you can make six figures and not be able to save any money because
You're paying all the
rent's so
rent,
much.
yeah.
So having those options to allow for 100% financing, and you have maybe limited $5,000 saved, what can I do with that $5,000 where we're talking about, like, if you want to do an escalation clause, if you're right over asking, you can use the money that you have towards that, and we can use that assistance to pay for that down payment and closing costs. So the money that you have, we can make it use for different resources.
Sure,
Yeah.
sure. Makes a lot of sense. So, Tony, does that picture change when we're talking about people looking for their forever home? And I know there's a lot of reasons they're either growing their family, so they need the bigger home, or they're deciding to have a more retirement-like home.
Sure.
How does that all change?
Well, they definitely have the experience. They probably have, the credit history with the house payments they currently have, assets, et cetera. But I would also stress it is important to have trusted partners, right? Find a realtor that you trust. Find a lender that you trust. You can educate yourself, but nothing's going to replace working with professionals.
Yes.
I can't tell you how much we work with people, and whether they bought a house, the last time they bought a house was 5 years or 20 years ago. Things change. I never needed this before. I've never had to do this. That's what we're here for.
Yeah, absolutely. So I just went through this process, and I hadn't bought a house in 20 years. I can't say enough about having a real estate agent and my lender, who just happened to be one of ours right here. But not only just helping me through the process, but they also had information for me on people who could do the inspection, on the things that I don't know. They gave me multiple names and resources so that I could really move through this process incredibly easily, I thought. It was just all to the benefit of having the right team.
And one thing they'll also help you do is make sure you're comparing apples to apples. And I can't stress that enough. In the age of online rate quotes and things like that, if it seems too good to be true, it probably is. Unfortunately, in our industry, we still run into the people that'll send this incredible rate quote, and then you'll go through the process and you'll realize they're charging thousands and thousands of dollars in extra fees in order to get you that rate. Well, that's not apples to apples, right? So you want to really work with someone you trust and that will walk you through the numbers in detail.
Yeah, and I know we're encouraged to shop rates. So that's more than just going online, right? For exactly the reason you said. So what tips would you have for shopping the rate? Would you look at top banks, top mortgage? Like, how would you do that?
Yeah, I mean, I would definitely go off of reputation. It's not always the cheapest you're seeing online and things like that. But when you really start comparing loan estimates where there's a rate and there's fees broken down, that's where you're going to actually see, okay, this is what this lender is really offering and this is what this is really offering. Once you get that and you see it on paper, that's when you can really make a true comparison versus just some email back and forth or some conversations over the phone.
That makes sense. Now, I know people get a little nervous about bridge loans. Are you still seeing people do those, especially those moving into their next home? Tell me about that.
Yes, we are. We see people using the bridge loans and or home equity lines of credit to really essentially bridge that down payment, right? To where they can access that down payment to, put down on their next home to get more favorable financing. So we are definitely seeing an uptick in that, and people, especially with how much the equity's grown on properties recently, in the last several years, it really is a great tool for making that next home purchase.
Yeah, and with the cost of houses having become so high, which we all know and we see every day, I know it feels prohibitive for somebody, especially I would imagine a new home buyer who thinks they have to come up with 20%. I mean, that immediately will shut down some people. Is that really what they're looking at, especially Sara, for new homeowners? What do they need to think about?
I mean, minimum down needed is 3%. That's the minimum you need to put down on a mortgage. I mean, like I said, there are options to do 0% down, but where that money can come from for that 3%, it can come from your own funds. It can come from if you can get a gift that is either from family or a family-like member. That can come from down payment assistance. If somebody is able to borrow money from their 401k, that can be used for your down payment. So that
was how I bought my first house, as a matter of fact.
Yes.
My very first home.
Yeah, that 3% down can come from very different options. And that's why it's important to sit down, figuring out how much do you need to put down, or if the price is higher, is there a way that maybe you could eliminate a debt so you could qualify for more? Just to look at different options and to, again, make your money stretch as much as you can.
Yeah, and there's something that's always been a kind of a mystery, PMI. So can you explain the trade-off and what that means? People they know it's something to be wary of, but few people can really explain what.
So what PMI is, private mortgage insurance. It's insurance that you pay that protects the lender in case of default. People think, oh my God, I have to avoid paying PMI because that's just wasted money. But depending on what your credit score is and the amount you have down, it will depend on how much your private mortgage insurance is. So the more you have down, the higher your credit, the less expensive it is. So when I'm looking at different options for people, I'll look at different programs. The private mortgage insurance can be different between just Freddie Mac first-time homebuyer program and the WIDA first-time homebuyer program, or FHA. With FHA, that's the only loan program where private mortgage insurance is the same across the board for everyone. But the difference is private mortgage insurance on a conventional loan falls off when you have 20% equity. So typically, if you do 3% down, it falls off in 10 years. With FHA, it stays on for the life of the loan. So if somebody does an FHA loan, I always encourage, call me in 3 to 5 years. Let's refinance and put you in a conventional loan. But it's not something to be scared of. I had somebody apply with me recently. They had an 800 credit score, 3% down on a $300,000 house. I think their private mortgage insurance was like $35 a month, and they thought it was going to be like $200. It's really not that bad. So just again, that's getting in front of your lender, having
debunked.
yes,
Very good.
have conversations early. Yeah.
And Tony, we've talked a little bit about payment strategies for the move-up buyers, but do you see a lot of them dealing with double mortgages, or is that something folks avoid right now?
As far as carrying both payments?
Yeah.
Some people do. We will, a lot of times we'll approve someone carrying both mortgages if they can afford it, because it makes a more attractive offer.
Okay.
But a lot of times what people will do is, they'll line up the sale of their current home with the sale of their other home. But in cases where they don't, sometimes let's say you're closing on the new home and you're not closing on the home you're living in now for a week or two after. What will happen is they'll get that money from their closing, and then they can put that down on the principal and recast their mortgage on their new one to bring that payment back down to where they want it to be.
So there are strategies if the timing doesn't work out quite perfectly.
And that's where the realtor and the lender relationships come in, because the realtor is going to be able to tell them the equity they're going to have in the house they're listing, and we're going to be able to help them with the strategy of what to pay down, how much to put down, and whether you do that at closing, after closing, etc.
Yeah.
So are you still finding that somebody with a contingency of needing to sell their home can be a problem in a competitive environment?
Yes. At least what I'm seeing, that's one of the biggest they run into is the sellers don't like seeing that.
They'd rather have an offer that's not
domino
tied.
they know has to fall before theirs will close.
Sure.
So we try to, with our pre-approvals, if we can qualify them with both where that's not a requirement, we will, but that's something we work with the client and the realtor with.
So you try to get ahead of that if that's the scenario with some options that give them a little more flexibility. Interesting. So let's talk about another thing that I think folks sometimes find mysterious, the credit scores, especially for these first-time homeowners. So what's how do you get the best rates? What can you tell us, Sara, about that?
It goes to, the higher your credit score, the better. What I'm seeing it affects more is private mortgage insurance or insurance in general, either homeowners insurance, your rate's higher. As a first-time home buyer, Fannie Mae and Freddie Mac, they don't have any adjustments to the rate if you're a first-time home buyer putting 3% down. That used to be, it would depend on your credit score, and there was a slight adjustment if you were below 680, and then there was no adjustment. But that was, I think, about 3 years ago now. So as a first-time home buyer, it's not really rate, it's that private mortgage insurance where if, say, you had a 640 credit score with 3% down at a $300,000 house, you're going to be looking at a payment of $300 probably versus the $30, $40 I said before. So that credit score affects that more than anything. How private mortgage insurance works, which I didn't mention before too, is it's adjusted by, again, the amount you have down. So if you did 5% down, that rate could be lower than having 3% down. They look at risk layers. Credit score is a risk layer.
So like anything else, the higher the credit score, the
better.
lower the risk, the better things will be for you. And people can pull their credit report early on and start to pay off debt, at least understand what's there. I think I've found that sometimes that's half the battle. Like pull that report and know what the situation is.
Well, having a conversation on what they should pay, because sometimes I have buyers that think, I need to pay off all my debt. And no, you don't. You sit down, navigate a plan of attack is what I say with my buyers. Let's have a plan of attack and see what do we need to get to, where do we need to get to, and I think we can get to that credit score to just that better level to get you a better rate in some way.
Right.
Yeah.
So, I think about the house that I grew up in. There were 3 kids, 2 parents, a myriad of animals at any given time. And it was a relatively small home. And then we saw the trend of people buying bigger and bigger and bigger homes. I'm wondering, has that trend continued? Do they continue to look for much larger homes? Is space the magic thing? Or are they getting smaller than they were before? What do you see with that, and what does it mean to buy a house that's maybe bigger than what you actually need?
Yeah, so I think everyone has that dream to have that bigger house, but I feel in the last year, buyers are now seeing the reality of, okay, I need to go back to this starter home level. And I think even developers are actually saying we need to go back to those starter homes because everybody's being priced out of new construction. I mean, they start, over $500,000, depending on the area. I mean, in Madison, it's almost $800,000 for new construction, just starting. So I think a lot of people are realizing, okay, I need to live in this home, this smaller home, 5 to 7 years, and then move up to that secondary home. But having those conversations and having that partnership with the real estate agent, saying like, have them to have the conversations with them too, and saying, yes, how about you do 1 bathroom instead of 2 bathrooms? Start building equity, and then let's move up in a couple of years.
Yeah. And I think it really goes in stages, to what Sara had said. You start off with the starter home, and, depending on size of family, then you start getting into that bigger home.
Yeah.
And then, even you'll get the next home that you're really growing into. That might even be a little big for now. But then you also comes when you start looking at retirement. Do you want to downsize? Do you want to get into a property with less stairs? Do you want to get into a condo where you don't have to worry about the upkeep?
It is so funny you say that, because I've always enjoyed space, because I had a large family, a lot of kids. The more space, the better. It was my mantra for a while. And we just bought a second home that might end up being our retirement home. And one of the things that appealed to me was that it was smaller. And I never thought I would get there, but there, from a utilities perspective, from a managing the house, the right layout, the space can be much smaller and still really effective for a family, I found. So that's interesting. So if someone was trying to figure out, okay, how can I figure out from my budget, what can I afford? Are there rules of thumb people should look at if they're just starting this process? Like, what of my income, how much should go to housing? And
so the rule of thumb so I teach a lot of homebuyer education, and we normally say your housing payment should be between 25 to 35% of your gross monthly income. So that's before any taxes are taken out. For debt to income ratio, so this is all your monthly debts that would port to the credit report, car loans, installment loans, student loans, credit cards. You can go up to 50%. We like to see it like 45 or below. So that's why having that conversation is like, could we pay off a car loan? Or if you have 10 months remaining left on an installment loan, we don't have to count that debt against you for qualifying. So then again, we can qualify you for more. But that rule of thumb is for that housing payment 25 to 35%. Sometimes we're seeing that higher. If you have 2 people living in the household, one might be in school still, or they might have a resident. They might be a resident. We see that a lot in Madison. So their income's lower, but we know their income's going to increase. So as long as they're comfortable with that payment, is my important thing. Is I'm like, you understand your payment is going to be X. Yes.
It's interesting, and so when I look at today's market in particular, we've talked about how competitive it is. And I know there are bidding wars. I know even in looking for this second home that I was looking at in northern Wisconsin that was pretty isolated, there were more than one individual, that they were looking at per day, and it was going really fast. And my real estate agent talked to me about a number of strategies to try to put our bid above any other potential bids. And it wasn't all about beating the asking price. What advice do you give people who are saying, look, in this competitive market, how do I win?
What I'd say is really trust your realtor. Different markets have kind of different trends. Depending on the contingencies, they're going to have your best interest, in mind, right? Again, we're not seeing as many of like waiving inspections or things like that. One thing we've
you wouldn't
seen,
advise that.
No. I would never advise waiving an inspection.
No.
Even if you have an inspection, the seller might not, remedy or fix the issues, but at least you know what you'd be getting into.
Right.
Because the last thing you want to do, especially for any buyer, is to go into a property not knowing that there's a crack in the foundation or that there's an issue with. Those are huge repairs.
Right.
Those can be major issues. But some things, for example, we see in our market is an appraisal gap coverage, right? Where the buyer will say, hey, if the appraisal comes in, X amount short, we will cover that. So there's things like that they can add to make the offer more attractive.
And what about you, Sarah? Similar things? Or?
Similar things. I would say I wouldn't waive inspection either. One thing is what they're doing is they're also putting an inspection buffer in there. So if they're saying if anything pops up on the inspection and it's going to cost less than $2,000, we're not going to ask the seller to repair it. But yes, I'm still seeing, I have so many agents that call me on Saturday and Sunday like, Sarah, can we waive the appraisal contingency on this?
And you're going...
There is, in some cases, I don't know if, Tony, you want to touch on it, but there is what's called an appraisal waivers we get, but we don't know if you can get that waiver until after an accepted offer. And it normally depends on, what the current market is in that area and how much somebody's putting down. Again, it's like risk layers is what's reviewed.
We're seeing cash, essentially cash offers in the market where they'll do like an asset secured loan.
Yeah.
On assets they have
some investable assets that can be tapped on, but used
as collateral. So they can do a loan
collateral.
on that,
Sure.
offer it as a cash offer, and then refinance the property afterwards if they'd like to pay that off. Yeah. So that's something we're seeing a lot of in the market too, because a lot of people are always saying, I lost to a cash offer. I lost to like, how do all these people have all these hundreds of thousands of dollars laying around in cash? Well, that's not necessarily the case. But when they do a specific loan or a special loan like that, they can make that cash offer to make it more attractive to the sellers.
Yeah, what was interesting to me in my experience was that the real estate agent said to me, one of the things they thought their real estate agent said would make a difference would be how flexible we were with their move out and move in time. And it was shocking to me. They were just delighted that we're like, hey, you tell us when you're ready and we can move forward. It worked out really, really well. But there are things that aren't necessarily paying more and more cash that you can be flexible with. Is that pretty accurate?
Exactly right. Especially, and again, that kind of goes back to the lender you're working with and the speed that they can, come through for you. And if you can do a short-term turnaround, that's a huge deal for sellers. If that matters to them, that can win the deal. But you have to have the lender that's able to do it.
Yeah, and that was why I was so delighted to work with us here, because it just was such a great process. But it was interesting when I had got word on this particular property. It was a Sunday afternoon, and so I had to go see it. It was a distance away, so it was a little bit challenging. And when I got there and liked it, it was presented to me that there were some weekend options for me if I needed an immediate approval. But it was very clear to me that the rate would be significantly higher for that as well. It would be a very emotional decision and a bad idea. So calmer heads prevailed. And I worked with us the next day. It was very, very fast about all of it. So that was really it's structuring these offers. It's really exploring creative ways to make your bid attractive and working with a really competent lender who can move fast. So for Forever Homes, I know people say consider the long game. What does that really mean, Tony? Because is that wheelchair? Is it long enough that I got to really think about door widths and things like that, or are we talking about different life changes?
Well, it's again going back to something you can grow into. That's one of those ones where location kind of trumps everything. You want to be, where do you want to be, right? There's other things you can do where as long as you're in the location, the neighborhood. Do you like doing recreation? Do you want to be in the city? Do you want to be rural? Do you want to be able to add to the home, right? You can always do add-ons, right? There's great programs to where we're seeing a lot of that now too, especially with the rates, is people remodeling, right? And doing large remodel projects where you can do a construction to permanent loan on that. So you can add to those homes. But for those Forever Homes, you don't want to sacrifice location. You want to be where you want to be. Know the school districts, right? Even if you have kids that are grown or not, or don't have children,
that's such
resale
a great point.
Value,
right?
For those, those are the properties that if you do end up, I say Forever Home, that might be forever. It might be for 20 years, and then you get to that point where you want to downsize. Well, when you do that, you're going to want a property that's going to sell, right? And those types of things have a lot to do with it. And not to harp on it, but that's where your realtor comes in too, because they know those things. They know the markets where the resale value is going to be better, but they want to make sure that they put you where you want to be.
Right. It's when I think about people looking at this this kind of moving forward, second, third home. I do see people going, I want to be at a place where I can do the things we love to do for that period of time that you have the health and the energy and the time to do it. So
Right.
whether it's by the lake or the hunting cabin or whatever it might be, but you're right, that doesn't necessarily mean forever. Because there is another stage where I do see people moving closer to family, to children, downsizing to adjust to the reality of as we age.
Or move down to warmer weather. They might.
Yeah, that too. We do see a lot of that. So it's important for people to really kind of think through all these things I would propose
Right.
and imagine you agree with. So when we think about first-time homeowner Sara, what advice would you give them to be more prudent in their decision making? Because I will confess, as a first-time owner and as a fifth-time owner, I can be a little emotional about the property I'm looking at.
Oh.
And it might cloud my judgment to an extent.
Yeah.
So what would your advice be?
I mean, be open. The first house you look at might not be the perfect house, might not be the house for you. Be open to different options that are out there, because with the different price range as a first-time home buyer, not having as much to put down, like I said, you might have to do one bathroom instead of 2 bathrooms. I want a 3-bedroom. I've had some people saying, I want a 5-bedroom house. And I'm like,
Yeah, because everybody wants their own room, right? It's like that's not always possible.
There's a basement you could finish, in a few years. But just be open, and when you're looking at properties, just being open and seeing it might not have like granite countertops. It might not have like all the bells and whistles that you want, but you can make it your own. Once you start building that equity.
So making it your own. So I am also guilty of being one of the people addicted to Pinterest and fixer-uppers and reels that show things just miraculously become beautiful.
Yeah.
So what advice do you have about people who go, I can do this fixer-upper. I've got YouTube. I can do this. What would you say about those kinds of things?
Don't do it. No, I can say personally, when I bought my house, I decided, I'm going to do the flooring myself. 4 years later, it finally got done. But it's just really like, yes, you need to have, if you're thinking about doing stuff, even if you think you can do it yourself, have somebody in your back pocket saying like, okay, if I can't do this, call your realtor. Like, hey, do you know a contractor that might help me be able to fix this plumbing that I messed up?
Yeah.
Just having tools with you and continuously after closing, your lender, your realtor are going to be tools for you. And having that inspection and knowing things.
Having the to-do list,
the
right?
to-do list
Right.
do the to-do list before the want list as well.
And really with the contractors, I would suggest meeting with multiple contractors,
Yes,
getting multiple quotes, because the spectrum right now is it goes from reasonable to high, right? I mean, find people that'll give you multiple quotes, because it can be all over the scale with those. Find some trusted contractors from your realtor, from your lender, people that work with those types of businesses, those type of organizations, but get multiple quotes.
Yeah, good advice, because it always costs more than you think. There's always something else lurking behind the drywall. But it's not always a bad thing, but to know what you're getting into is probably an important thing.
Right.
So a lot of, back in the day, all our communities were kind of isolated and, just going from Racine to Kenosha or Milwaukee to Racine or wherever we were going seemed like a trip. And now today people are used to commuting and working in different communities. How does that work when you're trying to find the home in the right neighborhood and you're trying to think about what's a realistic commute and how to go about getting things approved? How does that whole commute thing work?
Yeah, well, there are some rules on how far through Fannie Mae and Freddie Mac. They have a rule of how long of distance. There's a lot of remote workers now, so it might say your employer is in Milwaukee and I want to buy in Madison. So we might have to just show something from your employer saying you are a remote worker. But I have seen a lot of people purchase outside of the area for affordability reasons. But normally I think it's within like a 40-mile range is what's acceptable.
Tony, any additional comments on that?
Yeah, I mean, we're seeing a pretty big uptick on working from home.
Yes,
we really are.
So so the commute has maybe become less a concern than it used to be?
Yeah.
I would say so. We see a lot. I mean, especially after the pandemic, post-pandemic, I can't tell you how many people working from home that, and when I say working from home, I mean their company's in a different state.
Yeah.
And their employer will do exactly that. Like, yes, I understand we're in Massachusetts, but they work from home for us, and you know, and that's just kind of the nature of where we're at right now.
Yeah. Or it's like 50-50. So they're like, I can do the drive, 3 days a week, it'll be fine. And then the whole weekend I'll be at home.
So biggest mistakes buyers make. What if you had to identify the biggest mistakes, what would that be?
They don't ask questions.
Okay.
They wait until the week before closing and they're like, Sara, is my payment really this much? Can I do this? Are we sure we're okay? And just when I teach my homebuyer education, I'm like, I'm an open book. Ask me anything. Don't worry. Like if you're worried about something, just call me and ask me. Send me a text message, email. I don't want you to be freaked out the week before closing.
Right. When they see the closing costs that they didn't factor in.
Yes,
or things like that.
and just having those conversations up front. Those not having the conversations up front, I think, are the biggest mistakes, and they're just rushing through the process. Because I've even had good realtor partners call me like after closing for somebody who didn't use me, and they're like, Sara, can you explain to this person on why? Because they weren't able to get a hold of their lender, and now they're like, what did I just do? And they're like, I can't afford this mortgage. And so having those conversations up front, would probably be the biggest.
Tony, what have you seen?
I would say not doing due diligence, being more patient, not acting on emotion of seeing a home because it's exciting.
And it's exciting. It's new. You fall in love with it.
Yeah.
And also, the stretching the budget too far, right?
Okay.
One thing, so when we approve people, we see the debts they have in their credit, and it says like, yes, we can go up to this amount, and you can afford this, but we're not taking into consideration grocery bills and cable bills and all those other bills that don't.
And the what ifs. Right?
What ifs, right?
Yeah.
Also, especially with upgrading homes, taxes, right? Taxes and homeowners insurance, which has been increasing
a lot
noticeably over the past few years.
Yeah.
Right.
Those are things that constantly are changing, and more often than not going up, not going down. So taking all that into consideration, especially when you're upgrading to a larger home and maybe a little bit higher interest rate, is just understanding your budget of all the other things you have for you and your family to make sure that you're comfortable with that payment.
So words of encouragement for anybody who might be a little nervous about the market and all that we've just discussed today.
I've seen so many people get into homes so far, even this year. I've been fortunate to help, I think, at least 18 home buyers this year so far, and we're still early in the year. There are options out there for you. There's affordable options out there. Just sitting down, having a conversation, and saying like, this is where you're going to be, and get into home ownership as soon as possible and start building that equity. Don't wait until you have that 20% to put down.
Right.
Yeah.
Right. Tony?
Wisconsin has incredible properties at
They
all
do.
price points. They really do. Be patient, do your due diligence, and again, I want to stress, team up with trusted partners. Get a good realtor that you trust, get a good lender that you trust, and let them do the heavy lifting. They will walk you through it to make sure you get the best deal and that you get something you can afford for you and your family.
That is great advice. Sara and Tony, thank you so much for joining me today for your insights. This has been such a helpful conversation. And thanks to all of you for tuning in. If you have questions you'd like us to tackle, please go to the show notes, type your question, and hit submit. And make sure you subscribe so you don't miss out on any future episodes of Your Money, Your Mission, the podcast designed to turn complex financial situations into actionable advice, powered by Johnson Financial Group.
This podcast is not a recommendation to buy or sell any investment or financial product. Whether a particular investment or financial solution is right for you depends on the facts of your particular situation. Please consult your own professional advisors prior to taking any action based on the content of this podcast. Products and services offered by Johnson Bank, member FDIC, a Johnson Financial Group company. Loans are subject to credit and property approval. Bank underwriting guidelines may not be available in all states. Other loan programs and pricings may be available. Conditions, terms, and restrictions, including property and flood insurance, will vary based on loan program selected and property location. Private mortgage insurance may be required on loans with less than 20% down.